Let us now move on to the Unit 4 of the paper Management of Insurance Services. The Unit 4 will cover the life insurance policies, and within this, we will understand what is actually the need of life insurance products, how the life insurance products are designed. We will also peep into the types of life insurance products. We will see few products, life insurance products which are available in Indian market, and the life insurance product design with actuarial issues, life insurance products, how they are priced, and finally we will understand the procedure of life insurance underwriting. Now, in the previous sessions, we have understood that broadly speaking, there are two types of insurance. One is a life insurance, which is covering the death uncertainty of a person, and the other is a general insurance, which covers the other insurance of non-life products. So, life insurance basically is a risk management tools which handles the uncertainty of death. Now, when death is uncertain, that means no one knows when the time of death will come. So this definitely creates a risk, financial risk in the mind of the person who is actually doing income for one's family. So in this type of insurance, basically two type of risks are covered. One risk is the mortality risk, that is a person who is dying earlier than his expected life. And other risk is also existing when he is still alive, but he is living till a very much longer period of time till his expected life period. So in both the cases, risk is prevailing. So now life insurance policies cover both these types of risk, the mortality risk as well as the longevity risk. So insurance works by transferring this risk from the individual person to the insurer. So insurer is the company which covers the risk which is perceived by the individual person. Now insurers assess, price and accept only risks they can measure confidently. So now insurer, as we have already discussed, that whenever a proposer or a individual submits the life insurance policy, it is up to the individual company, the insurance company, who evaluates and then sets the premium, the price which the the individual who is taking the insurance, he has to pay. And of course, they have to measure the risk which they are going to cover. So insurance company's job is to assess the price as well as they accept the risk which they can measure very confidently before accepting the policy. So modern life insurance is based on the actuarial sciences, which we have already discussed, like what can be the expectant life cycle or life table for a particular person, how the probability or chances of happening of a particular event, like how far it is possible, probable that a person will be liable to accident. Mortality data, everything they are calculating in numerical terms, and then they are evaluating whether they are going to accept the life insurance proposal or not. So the purpose of the life insurance is just to protect the safety of the dependents, because whenever in a family, suppose one person is having income, so there are four other persons who are the dependents on the family. So the purpose, is main objective is that it protects or safeguard the safety, security of the dependents. It ensures the financial security, and it's also manages the uncertainties which are going to incur in the life cycle. So moving on to the need of life insurance products. So every product, there are different types of schemes which are available in life insurance also, which we will be discussing in detail in the further slides. So based on the need of the individual, the different types of schemes are being customized by the insurance company. So every person must address a real customer need. Life insurance is no exception. Customer need change over time, which is influenced by age, income, lifestyle, and economic environment. So the person who is within a teenager maybe, so he will have different types of need. A person who is just married will have a separate type of need. A person who is at the verge of retirement will have a separate type of need. So, depending on the needs of different life cycles of an individual, the life insurance products have been customized or designed. Life insurance products are continuously redesigned to match these changing life cycle needs, and these needs also goes on varying. Suppose a person who is in the middle age, when he goes to the retirement age, his needs varies. So the needs will differ across different economies. That means in India, the need of an individual will be different than the person who is residing in US. So in different economies the needs will vary, among different cultures of the society the need will vary, and of also among different family structures. Suppose a person is residing in a nuclear family, suppose a person is residing in a joint family, the needs of both the different type of family structures will definitely vary. So based on these needs of the customer, the different types of products of the insurance policies have been designed. So let us just have a brief look on the life cycle stages and its relevance on the insurance companies while designing a product. So here the age group is from 0 to 40. So when it is from 0 to 22, it is very much obvious that that individual does not have an income and he is dependent on the parents. It is his education period. So generally these type of person who is from 0 to 22, in most of the cases, general cases, they don't need any sort of insurance. But there are also exceptional cases who are early earners, and there are also exceptional cases who are married very early, so they can also go for certain insurance products. Similarly, within the age between 22 to 28, a person may start earning income. So they may have education loans, early responsibilities. So insurance depends on the dependence and the financial awareness. So here, if the person who is just starting his income, he suppose he has his old parents with him. So obviously his dependents, he will do some sort of insurance for his parents. Now parents might have some health issues which in future may create problem for his own. So that is why he might afford to have a insurance policy. And also it depends on that in that particular age whether he is having that financial awareness about the different types of policies available. So that when he is having a good income initially, then he might have planned for a home loans. Early home loan planning can also improve the understanding of the insurance value. Now moving on to the next phase of the life cycle, that is from 28 to 40. Now there, when after marriage you'll have children, and then the children go for education, so then the expenses goes on rising. So you will have to have maybe a car or a house, or your lifestyle changes. So for vehicle purchase you will have insurance. For purchasing a house you need to have insurance, and gradually when you go higher up to your up in your age, then the exposure to risk become more higher. So here in this type of stage you have a strong need to predict or forecast the future, and then have or purchase or afford a life insurance accordingly. So affordability may be a constant, but protection is very much essential here. Here the person, like in case of a life insurance, you have to, like it is a for saving, you have to dispose of some amount from your income every month or in a particular interval of period. So now you have to take off that much amount of money from your income. So maybe affordability with an individual may be a constant, but again, it is very much essential that you get a protection against your uncertainty of life. Now, moving on to the next phase, the age between 40 to 50, the income grows more faster than expenses. Then comes the main phase of your child education when he or she is into a technical professional background, maybe, or you are planning the marriage of your children. Then it becomes more vital that you have more better financial planning. So, there is a need for long term savings, and also the provision has to be made at the right time for your old age. Now, in the old age, also, when your children are outside or children are not with you and your income is also not there, then you should predict from the correct age that you have your own provisions of the old age. Now, when moving on to the age between 50 to 60, their children become independent. Income now is greater than the expenses. So, old age priority becomes, planning becomes a top priority. So, here transfer of wealth to the next generations become more relevant. And then post retirement 60 plus, employment stops, and here the mortality risks reduces because there are no dependents upon you, because your children are already settled their life. But here, yes, longevity risk increases. Suppose you are not dying before your age of 60, before the age of retirement, then your at that point of time your longevity risk increases. So here also a need based insurance can also be availed from the insurance companies. So basically, there are two fundamental needs that drive all the life insurance products. First one is, we have already understood, that is a mortality risk. So here, when it is a mortality risk, so protection need is very much essential. So managing the financial risk of death. So beyond your death, the money should be given to your dependents, who are your wife or children. Now, the next need is your saving need, which is accumulating funds for future life stage goals. That is your saving need. Suppose you want to do the marriage of your daughter, or suppose you want to have some studies for financial planning for the study education of your child, then maybe your pension plans, everything, that saving need also can be fulfilled through the life insurance policies. Now let us move into the different types of designs of a life insurance product. So life insurance works on a contract. So now the insurer pays a benefit on death or survival in return for regular or lump sum premiums. So this we have very well understood, that every individual who is taking who is undergoing the contract of an insurance policy, who is availing an insurance policy, has to pay a premium at regular intervals. It may be monthly, it may be quarterly, or it may be that they have to pay the premium at one point of time, a lump sum premium. So in return of that, the insurance company pays the benefit, maybe after the death of the person or during the survival of the person. That is the main theme of the contract. Now, as we have already understood, that the two fundamental needs that drives all the types of life insurance products are the protection need, which covers the loss due to death, that is term insurance, and the savings or investment need, which builds funds for goals, that means maybe retirement or education or loans. So these type of products are known as endowment products. And when it is term insurance, we are protecting our life. When it is for a future goal, we are saving something for a future goal, that is known as endowment products. So this differentiate, term insurance is related to mortality risk, endowment products is related to the savings of the individual. So market products which are existing in the life insurance are a combination of both the protection as well as the savings or investment needs. So the main categories of life insurance products includes, we will understand this one by one, a whole life insurance, a term insurance, endowment insurance, annuity contracts, unit linked contracts or ULIPs and index linked contracts. So we will understand this one by one very briefly. Before moving on to the types of main categories of life insurance products, we'll just define few terms which are related to the life insurance contract. So policyholder, who is a policyholder? Policyholder is a person who buys the policy. That means he is the proposer of the life insurance policy. Life assured, that means the person whose life is covered. Suppose it is the father who is having income in the family, then it is the life assured of the father. So person whose life is covered. Suppose your parents are in the old age and you are going to cover the life insurance for your parents, then it is the parents whose lives are assured. Sum assured means the guaranteed amount payable by the insurer. So sum assured is the amount which, after if the insurer is being paid the premiums at regular intervals as defined in the policy, then the life insurance company will definitely pay the sum assured which is mentioned in the policy. It is a guaranteed amount which is payable by the insurer. Surrender value. Now sometimes what happens, the policy which is being availed by an individual might be surrendered or might be given back. The contract will end there. So in that case, they will not get the entire sum assured, but they will get some discounted amount which is being calculated, which has a calculation value. So it depends on the number of premiums that you have given. Also, there depends on the amount of sum assured which you should receive, and there are so many other factors which determines the surrender value. So it is at a discounted amount that you get when you are surrendering the policy to the insurance company before the policy expires. Now nominee we have already discussed. The person is a nominee who receives the benefits on death of the life assured. So suppose the father is having a premature death, then the nominee, suppose he has kept his son or wife as the nominee, then the nominee is the person who receives the benefit after the death of the person who is the life assured. Now riders, we will explain about the riders later on also in the subsequent slides, but to be very brief, riders are actually the add-on benefits that enhance the coverage. So you might get certain bonus on the when there are certain riders. Suppose a person, if he is having a death in accident, then he will have a certain amount of bonus. Suppose a person is having a normal death, then he'll get his sum assured. So riders are certain, you can say certain conditions which may add extra benefit or extra insurance coverage. Another term is known as participating products. Now, in some of the life insurance schemes, the entire amount or maybe some portion of the investment is invested by the insurance companies in different market-linked securities. So here, when it is invested in stock markets, in market-linked securities, so there the insurance companies earn certain amount of profit. So that profits the insurance companies will share with the insurance policy holders. So it shares in insurers' profit, and profits are paid in bonus, and at least 90% of the profits must be distributed as per the regulations. So as per the IRDAI regulation, the insurance company can distribute 90% of its profits which is earned by investing in the stock markets. There are non-participating or non-par products where there is no need of sharing any sort of profits, and here what happens, the benefit is guaranteed, the sum assured is guaranteed and fixed. But in case of participating products, here the sum assured is not fixed, it is if the person is if the insurance company is getting a profit, that will be distributed. If profits are more, then you get more amount. Now let us move on to the different categories of life insurance products. We talked about what is a whole life assurance product. Here in the previous slides, if you can see here, we said that there are two types of need. One is a protection need. Protection need covers the financial loss due to death. So it is known as term assurance. So, and second one is savings and investment need. That is known as endowment products. So now when we talk about this whole life assurance, this is covering the uncertainty of life. That is a life risk. So whole life means till the death of that person. So whole life assurance is a type of life insurance that covers a person for his entire life. When the insured person dies, the insurance company pays a fixed amount called the sum assured to their family. So if he doesn't die, then the insurance company will not give the money. If he dies, maybe he dies at 90, they will get after that. If he dies at 60, then they will get after that. If he dies at 100 also, then you will get the dependents will get the money only after his death. You cannot get an amount before his death. So you pay either one big amount once or small regular premium. So at a time, a person can pay the entire amount of 5 lakhs or 10 lakhs, or at regular intervals, premiums can be paid, annuities can be paid. So that means you can pay the premiums maybe every month, maybe quarter, maybe yearly. Annuities of premium can be paid, and which covers the till the death, no matter when it happens. As I said, it can happen in any age of your life, so it covers till the death. So till the person dies, the person has to pay a premium, and the money is given to the family when the insured person passes away. So this gives a lifelong financial security to the dependents. Dependents are the family members, other family members, the children, the wife, everyone is the dependent. Now it helps cover funeral costs also, inheritance taxes and other duties after death. It helps to transfer the wealth to the next generation. And the extra features of this policy, the whole life assurance policy, is many plan to pay the money to the insured after they reach a very old age. In India, it is usually 100 years. Sometimes what happens in most of the cases, you can also have a surrender value. That means you can, suppose you expect that the life period is 60 years or 70 years. Then you may wait for 70 years, or he may not die for 70 years, or you may die at 100 years also. So sometimes what happens, you can also surrender your policy early if you need some money back, or you are in urgent need of the money. Then you can also surrender the policy and get back the surrender value. But surrender values are definitely a much discounted value, which depends on the number of premiums or amount that you have paid to the LIC, the life insurance company. And the policies can be par, that means participatory products, that is on profit sharing basis, or the policies also can be on non-participatory products. So on when you are investing the amount in the stock market, you will not avail any sort of profits. The next type of category of insurance is the term insurance assurance. Now here also, when we talk about term assurance, whole term assurance, it is purely linked with the protection of life. So term assurance is pure protection insurance. That means you choose a specific time period, say 10 years, 20 years or 30 years. Now, if the person dies within that period, the family gets a sum assured. If the person survives the term, that means suppose you have made a policy till 20 years and you will get the money only after 20 years if the person dies within 20 years. But if the person lives beyond that 20 years, then you are not going to get back that money. That is known as a term insurance. So it is not a savings to the individual. Only if he dies within that particular year of life insurance period, then only they will get, the survivors will get the money. So it is a protection only, it is not a saving. This is how it is different from the whole life insurance. So you can pay a premium once or a single amount, or regularly, monthly or annually. So usually the full amount is paid in one lump sum. Sometimes it also can be paid in monthly annuity, and it protects the family if the main earning member dies. It also helps to cover loans. For example, if someone has a home loan, the term policy can ensure loan is repaid even if they die. Banks also use it as a guarantee for interest only loans. And this type of policies are also availed by few companies who term the insurance on a very important employee, a key man. So one of the person who is a key person of that company, they can have certain this type of term insurance for that key man. So if that employee if the key man dies, the company gets money to cover losses. So this type of insurance is also used for protection of business. And most term policy do not give any money back if the person survives. That means there is no surrender value. In case of a whole life assurance, here you have a surrender value. You can surrender your policy and get some money back. But here in case of term assurance, it is that you do not get any sort of surrender value, or you do not get any amount if the survivor, if the person who is the life assured, he survives beyond the number of years which is there in the insurance policy. And this type of insurance are usually non-participating. That means you are not going to get any sort of profit sharing or bonus in this type of insurance schemes. Now the third type of scheme is endowment assurance. Now in endowment assurance, as we said, that there are two types of needs of a person who is going for life insurance policy. First one is life risk, mortality risk, other one is savings. So here endowment assurance is a combination of both the life as well as the savings. So if you choose a fixed number of years, you will survive till the end of that period, you get the money. So if you are, suppose it is a life insurance, you have fixed that I am going to pay for the insurance premium till 60 years. So when you turn 60, but you still survive at the end of that period, you get an amount which is the sum assured. Suppose you are going on paying a premium of, let us say, 2,500 every month till you become the age of 60. It has been mentioned that till the age of 60, you will pay this much amount of premium every month, and your sum assured will be, let us assume it is 10 lakhs or 15 lakhs. So now sum assured is after the attainment of 60 years, you are definitely going to get the sum assured, that 10 or 15 lakhs you will get it. But if you die before that, suppose you are dying before the age of 60, so now in term assurance and whole life assurance, you are not going, in term assurance, you are not going to get the money back. But here in case of endowment assurance, the person who is a dependent, he or she gets the money of the life assured. That means when you yourself survive, you will get the money. When you don't survive also, your dependents will get the money. This is the endowment assurance. Whereas in case of term assurance, if you survive beyond that period, you are not getting the money. So usually here the premium are paid in lump sum, or it can be paid in monthly basis. And people like to have endowment policies because it helps them to save for their future goal. Now suppose you survive the period. Suppose you survive the age of 60 and you get the money, the sum assured you will get. So that amount of money, 10 lakhs, 15 lakhs, 20 lakhs, the amount that you get, that amount is going to help your retirement. Maybe it will help you in your child education or marriage or any sort of other financial obligations that will lie that time. So this is a saving also. The special feature of this type of policy is that even if you die early, your family, the dependents also are going to get the money, which you would not have been able to save, literally, even if you have tried to save the amount in your bank account. So there is a special version called pure endowment also. Here the money is paid only if the policy holder survives till maturity. If you die before that, nothing is paid. That is a pure endowment. So this is the opposite of term assurance, and this type of policy does not exist nowadays. The surrender value, we have already discussed that if the policy is surrendered before the maturity date, then a discounted amount will be given to the life assured. In the endowment plans, there can be participative also. That means you get the profits which are earned by the insurance companies, and it also can be non-participating. That means you may not also get the bonuses or profits which are earned. It can be of two types. Next category of contract is annuity contract. So we know that the premium which is paid at a regular interval is an annuity. All of us know that annuity means it is an equal amount of payments or receipts at regular intervals. Now, when the premium is paid, as I said, an example, maybe 2,500 is deducted every month from your salary account towards the policy, life insurance policy. So that is a premium and that is an annuity, since amount is fixed and interval is fixed. So when it is lump sum, it is not a annuity. But yes, if you pay at regular intervals and the amount is also fixed, that is a annuity. So now payment of premiums are annuity, and here suppose you are going on paying the annuity premiums at a particular intervals, or suppose you pay a lump sum amount of money at till a particular period, maybe 15 years, 20 years. After that, post retirement, you start getting a regular income, maybe monthly, maybe quarterly, or yearly, depending on whatever schemes you are going to choose. So that is why it is a annuity contract. So when you get monthly, you get a fixed amount monthly. When a quarterly also, you get a fixed amount which is equal amount, which is you get it quarterly. So that is why it is known as an annuity contract. So payments are made only if you are alive on the date of payment. That's why annuities are considered long-term retirement products. These are you are going to get only after post-retirement. When it is long-term, after retirement, you do not have any employment. So these type of schemes will be helpful for you to get a regular income. So people buy this type of annuity contracts to have a steady income after the retirement, or their dependents have a regular income in future also. So annuities can be of two types. One is immediate annuity, or another one is a deferred annuity. So you start getting immediate means after paying the premium, maybe you paid a lump sum amount of premium. So you start getting your annuities maybe from the next month. So you suppose you pay 10 lakh or 15 lakhs today, and from the next month you start getting receiving 2,500, 3,000, anything equal amount every month. So that is an immediate annuity. But deferred annuity, as we said, that you go on paying your premiums till a particular period or age, that is 60. So beyond that, you start getting your annuities or income and in different time intervals. That is known as a deferred annuity. Now, next type of scheme is unit link contracts. So unit link contracts are also known as ULIP contracts. Here it is a combination of both the insurance, life insurance, as well as the investment. Here, the companies invest the funds which are collected in the market, like in mutual funds. So they invest in the market linked assets like equity, debt, or balance funds, and in return, the policyholder gets units, like it is buying the units of a mutual fund. So when the market goes up, the value of the units also goes up. So your fund goes up. So when you have invested this much amount, a particular amount, let us say 15,000, 30,000 per year. So in that particular year, you will see if the unit value goes up, that means like in a share price goes up. So your value also goes up. If it falls down, then the money value, fund value also falls down. So because you choose the investment type, the investment risk is also on the individual person who has opted for the insurance. So when claims happen in case of a death or maturity, the policy pays the value of the units at that point of time. So if during initially the value was 10 rupees, if during the death the value is 120 rupees, you will get the value at 120 rupees. So some ULIPs offer a minimum guaranteed amount also. So that means if the value falls also, you will get a minimum sum assured of maybe 20,000 or 30,000 or 2 lakhs or 1 lakh. So it is also a minimum guaranteed amount is also fixed. So ULIPs are designed for people who want both a life insurance protection also, and also who want to have their fate destined in the stock market, who wants to invest in the stock market also. So market linked investment growth, if they want, then they can offer such type of policies. So it is a hybrid policy of between the insurance as well as the mutual fund. So we were talking about riders. Now there are riders which are put in different types of insurance schemes, and these provide extra benefits for the insurance policyholders. So riders are extra benefits which are added to the life insurance policy. So they are not full policies on their own, but they are certain conditions, you can say, which are put in the policies so that the policyholder can have benefits when such type of conditions are fulfilled. So think of them as add-ons you buy by paying a small extra premium to increase your protection. Suppose normal life insurance policy you have taken, and you have taken that in case of a cancer, the policy also has a rider of cancer. Suppose you have cancer, then you will get a sum assured of maybe normal policy will give you a sum assured of 10 lakhs, and if you have a cancer, then the sum assured will be 15 lakhs or 20 lakhs. But for having that rider into your policy, normal life insurance will call for a premium of, let us assume, 1,500 rupees per month. When you have this rider, then you might have to pay 2,000 rupees per month. So your premium also increases when you go on adding such riders into your policy. So some sort of riders are like critical illness rider. You get a lump sum amount if you are diagnosed with a serious illness such as cancer, heart attack, kidney failure, paralytic stroke, major cardiac surgery. So if you confront this type of things, then you are going to get some extra amount. But for this extra amount, you are going to pay some extra premium. So there can be disability rider also. If you become permanently disabled due to an accident, then the rider will pay benefit. There are riders like accidental death benefit rider. So in case the person is dying with accident, then the nominee can receive some extra money also beyond the basic sum assured amount. But here it should be noted that for that extra benefit which is there existing in your policy, the premium amount also increases. Term rider gives an additional death benefit over and above the main policy document. Here, it is paid either as lump sum amount or monthly installment to the nominee. There is waiver of premium rider also. If you suffer an accident or disability, you don't need to pay future premiums, but the policy continues normally and you get the sum assured after a policy matures. So these are some type of riders which can be included, which are there included in the policies. There can be guaranteed insurability rider, which allows you to increase your insurance coverage later without any medical test. It is helpful when suppose the income rises of a person, income rises. So he can add some more benefits to the insurance policy so that his insurance coverage becomes more wider and he gets more amount of sum assures. The spouse insurance rider, here it provides the insurance coverage for your spouse under the same policy. Another rider can be surgical assistant rider where it pays benefits if you undergo a special surgery or face any sort of medical emergencies, then such type of riders can also be added. Now there are the moving on few to the regulations of the life insurance product. We have also discussed about this regulation in the previous unit. So life insurance works on a very sensitive promise. People pay premiums today and the company promises to pay the benefits many years later when they are in problem. So because of this, the government has to make sure that the insurance company remains financially strong. Since the insurance company is going to give the benefit to the customers only at a later date in future, and future is always uncertain. So that is why a strong rules and regulation has to be there for the companies, and it should be seen that the insurance company remains financially strong to repay the claims or to settle the claims of the insurance holders. They should ensure that the insurance policy companies, they should not misuse the public companies by investing in different other securities. They should deliver what they have promised in the policy document, and all the customers should be protected as per the policy guidelines. So in India, the regulatory authority is IRDAI, and who designs the policies, who sees that the companies stay solvent, and the claims are paid fairly and on time, and customer interests are protected. So they prepare, or they are the main authorities which provides the framework within which the entire life insurance companies operate. IRDAI issues rules for how insurers should design the life insurance products also. So the linked life insurance products regulation 2013 and IRDAI non-linked life insurance products regulation 2013. So within these regulations only the life insurance products are designed. Now I will just quickly browse upon two types of life insurance products like SBI Sukh Nivesh. This is an endowment option as well as endowment with whole life option. You get a basic sum assured plus bonuses at maturity. If death happens before maturity, the nominee gets the sum assured plus the bonus. So sum assured on death is higher of, that means you get basic sum assured which is there in the policy, a multiple of premium, or you get 105% of the premium paid. And a single premium version is also available. So you have to pay premiums at different intervals, or you can pay the premium at a single point of time. So the key benefits of this Sukh Nivesh policy were that it is deferred maturity payment options. You take maturity money as yearly, half yearly, quarterly, monthly income for 5 years, 10 years, 15 years or 20 years. So it is, you can get the benefit only at deferred payment options. It is up to the policy holder how you are going to get the policy, get the money back. And there are three riders available in this policy. Riders we have already discussed. It is preferred time rider, accidental death benefit rider, and accidental total and permanent disability benefit rider. So when you have different types of riders, the premium of this policy goes up. It increases when you have different types of riders into it. Similar is another type of policy which is LIC Jeevan Umang. This is also a lifelong protection plus yearly income lump sum maturity benefit. So here after you finish paying premiums, you get 8% of the basic sum assured every year till 100 or till your death. So you get 8% of your sum assured. At maturity or on death, your family gets a lump sum. That means sum assured plus bonuses plus the any other additional bonus or riders as per the riders. So death benefit, it is paid if all the premiums are paid. And what are the additional bonus or payments that is received? It is 10 multiples of the annual premium or the sum assured on the maturity or the basic sum assured, as the case may be. And minimum death benefit which ones get is 105% of the total premiums paid. Here the survival benefit, if the person survives, then after premium paying term ends, so the survivor gets 8% of the basic sum assured every year till the maturity or till the death. At age 100, basic sum assured plus bonus plus the additional bonus as per the riders. So there are optional riders like accidental death or disability rider, accidental benefit rider, new term assurance rider, and new critical illness rider. So this policy is ideal for a person who is wanting lifelong cover, who wants that a regular income should come after a certain time period, and who wants a guarantee maturity payout. With, of course, a profit participation if the policy if the policy, the insurance policy company gets the profit out of the investments that they have made. So life insurance products design the actuarial issues. Life insurance products must satisfy three groups. One is a shareholder needs, which are actually the direct stakeholders of the company, the distributors or channel needs, and the customer needs. Shareholder needs should have the adequate profitability. That means the policy, the company who is providing the insurance policy should be profitable, or else they will not be able to settle the claims aptly or accurately. They should use their capital efficiently, and they should of course have a high volume of business, because when you have high volume of business, more number of cash flows will be there with the companies, which will be able to scale the business up to a great extent. And of course you have to see the benefit of the distributors or the channels. That means the persons who are going and selling the insurance products to the ultimate customers. So that is why this the schemes which are available by the insurance companies, those schemes should be very simple, and those should be easy to explain and to sell in the market. It should be competitive with the premiums which are given by the other competitor products in the market. The distributors or the direct sellers or the channel partners should get a good remuneration, and also there should be minimal underwriting. That means they should not take more percentage of extent of risk. And as far as customers are concerned, there should be life and health protection, there should be wealth creation and savings, retirement incomes, that means in terms of pension and annuity schemes, and there should be minimal exclusions and simple underwriting. So these needs often conflict. So there may be conflict between shareholder needs, or since it is having an interlinkage between satisfaction of all these needs. So higher commissions reduce the profitabilities, higher underwriting increases the risks, and product design is about the balancing this interest. So when you give higher commissions to the distributors or the intermediaries, of course that will reduce the profitability of the company. When if you don't have a minimal underwriting, if you increase the underwriting content extent of the insurance policy companies, then there is a increase in risk by the company. So that again, all these things can be subdued if you have an efficient product design. So actual policy inputs actually matters. Insurance companies take risk on their books to survive long term. So that is why they need to price their policies, products very scientifically. So there are rules we have already discussed about the different types of different rules, or you can say the concepts based on which they are formalizing the price of each of the different types of insurance policies. So the risk must be financially measurable. So if you see that a person who is not having any sort of medical issues, the risk covered for that person, and a person who is suffering from a diabetes, or a person who is already having one stent in his heart, so there the risk is again doubled. So that the risk must be financially measurable by the companies. Sufficient data is needed to estimate the probability of the events of occurrence. Like a person who is not having any sort of medical issues, of course he will not have he will have less chance of having a probability of a heart attack or dying early. But yes, of course, a person who is already having a sort of disease might have a chances of having a heart attack early. So there should be sufficient data to substantiate, to estimate the probability of an event being occurred. So large number of similar risks, that means law of large numbers, that we need to predict adequately. What is the probability that such type of events will occur at how much interval of time? When we see the pattern, and so that we can very well make a adequate or accurate prediction about the probability of happening a particular event. Like suppose a person is working in factory as a wage worker. So probability of happening of that event, suppose some accidents within that factory in the machine, so that becomes more probable. So you have to see the pattern, how many times or what is the number of times the factory machineries, there are issues with the machineries of the factories, and how many times the accidents have incurred. So then only we can have a more accurate prediction. We should understand the characteristics of different groups of people, like homogeneous group, it is male or female, smokers, non-smoker, so that we can very well finalize on the pricing. So pricing is nothing but the premium that is considered to be paid by the policy holder. And risks also must be independent. One person's claim should not be affected by another person's risk. So it is very carefully the insurance companies need to design their products and accurately price their products, so that it is affordable also, and also their business also will grow. So the pricing actuarial issues, it matters because accurate pricing will give actually fewer surprises. When you price it accurately, then you will see, if you study the trend properly, pattern properly, then you will see that the life goes on as you have predicted. There are the lower uncertainty is equal to lower reserves and better capital efficiency. So if the uncertainty of happening your prediction is better, so uncertainty happenings in future, if it is less, then of course there you will need less amount to settle the the claims of the insurance policy holders, then there will be better capital efficiency. So large pools reduce the deviations from expected results. So you need to have more and more people who come and purchase your insurance policy, so that there will be you will have less deviation from the expected results. So pricing is equal to cost benefit analysis of the insurance products. Insurance pricing follows a very simple equation: value of inflows is equal to value of outflows. So how much they have received insurance premiums plus the intangible benefits for the customers. So when they are having a policy and they know that my life is secure in future, they get stress free life, they get a peace of mind, and they get security. So inflow is premium plus the intangible benefits for the customer, and outflow is the claim payment, expenses, and the distribution costs. So now insurance point of view, premiums are collected must be more than the expected claims, expenses plus the required profit from the insurance policy maker's point of view. But from the customer's point of view, the benefits which they have received should be more valuable than the premium that they have paid. So both of them should feel that they have got their value for money. Now, pricing depends heavily on the assumptions that mortality, longevity rate, interest rates, the expenses that is being made, inflation rate, the persistency and the withdrawal rate, that means surrender rate of the policyholders, then business volume and business risk, and there are several other factors like tax rates and cost of capital. So life insurance underwriting, we have already discussed that underwriting is how much amount of risk the underwriter or the insurance company is willing to take. That is nothing but underwriting. When you have a minimal underwriting, definitely the insurance policy company has a more chances of having more growth. But when you have more underwriting, then of course the chances of risk also increases. So now risk management or risk assessment is very much important for in the case of the insurance company. So underwriting can be medical underwriting, it can be financial underwriting, it can be lifestyle underwriting. So the insurance company needs to very much focus on what is the medical background of the person who is availing the policy, what is the financial status, it's his income tax, how much income tax he has made, what is the salary proof, what are the CA certificates. It has to investigate everything before taking a decision of underwriting. How is his lifestyle, what is his disease record, everything the insurance policy companies need to know when they are deciding on how much amount to be underwritten. So before winding, let us just go through few of the premium terminologies. We talk about premium. Premium is the amount which the policy holders have to pay to the insurance company to get a security of their life. So premium can be of three types. One is a risk premium. This is a pure cost of insurance. It covers only the expected claim amount based on the risk. So it doesn't cover the expenses, no profit margin or no taxes which is included. Next comes, it is elevated to office premium. Here the risk premium, risk coverage premium of the life insurance, as well as some extra expenses which is incurred by the company, like the administrative expenses, the commissions which is paid to the intermediaries or the persons who are selling the insurance products, the taxes and the profit. Some amount of profit is also added. So here that becomes your office premium. The risk premium which is covered plus the extra expenses. So this becomes your theoretical premium. But finally, the actual premium which is paid by the policyholder is the amount of premium which is charged to the customers. So it may be higher or it may be lower based on how much the customer can afford. It depends on his income level. It depends on the scheme. It depends on the risk of his coverage. So how much the customer can afford. Of course, there are several players in the market. So competitive rate is also matter to be seen. So how much premium is offered by the competitors of different products in the market, and of course it also depends on the marketing decision. So actual premium is equal to the office premium, which we have derived in serial 2 office premium, and which is adjusted after taking all the other real world factors into consideration. So this is all about the life insurance policies. Thank you. We will move on to the general insurance policies in the next unit.